Welcome to Pro Webcast News, where we bring you daily industry updates. Today is Tuesday, November 10th, and you're watching the Afternoon Update with Paul Wilson. Today's news is sponsored by Game Plan Financial. Every agent needs a game plan. For more information, please visit www.gameplanfinancial.com. Now for today's headlines. U.S. small businesses became slightly more optimistic in October, but remained cautious due to continuing weak sales, according to a survey by the National Federation of Independent Business. The Federation's monthly Small Business Optimism Index rose for the third consecutive month, climbing 0.3 points to 89.1 in October. Meanwhile, the top business problem cited was weak sales, which have also made it more difficult for many small business owners to get a loan. According to the group, quote, with very weak plans to make capital expenditures, add to inventory, and expand operations, it would appear that many of those trying to borrow are having cash flow difficulties due to very weak sales, unquote. Finally, sectors planning on adding jobs include professional services, finance, insurance, real estate, and manufacturing. In related news, U.S. consumer confidence declined very slightly in November after October's drastic decline, leading to hopes that the upcoming holiday season will improve consumer spending, according to the IBD-TIPP Economic Optimism Index. The index fell to 47.9 in November, from 48.7 in October, still hovering near 50, which marks the delineation between optimism and pessimism. The index currently sits exactly at its 12-month average, and is 3.5 points above its reading of 44.4 in December 2007, when the recession officially began. Meanwhile, the survey's 6-month outlook component fell 0.5 points to 49.2 in November, from 49.7 last month. In insurance news, the National Association of Insurance Commissioners recently approved the development of a new model intended to measure risks in mortgage bonds held by insurers and help to reduce reliance on traditional rating companies. The group of state insurance regulators says the move is due to a loss of confidence in traditional rating companies such as Standard & Poor's, Moody's Investor Service, and Fitch Ratings, which have received criticism in the wake of the financial crisis. The new model would rely on a third-party designation of the risk in holding mortgage bonds, rather than only ratings created by the rating companies. In addition, the new model would also address the criticism that mortgage losses are not treated appropriately under the current model, as they determine the capital that insurance companies must hold against the securities. I'm Paul Wilson, and thanks for watching Pro Webcast News. For more in-depth news and features, visit producersweb.com.